Hello, I'm just waiting to see if anyone else is going to sign in. Um, Hi. You got some very swanky glasses there. I really like that style. Have you been watching The Matrix lately? I can't hear you. Can
Amazon, $20.
yeah.
Just call them up, put them in your case.
Have you been watching Morpheus from The Matrix? The Matrix?
The movie?
Yeah.
I've never seen that, no.
You never seen The Matrix? Oh my
No.
God. You need to watch The Matrix, man. Um, anyway, I mean, it's a great movie. It's epic.
I know, well, I know my son watched it. I'm just old, I watch well, I watch all your English shows on PBS,
Yeah, The Matrix is old as well, man. Anyway, um, okay. So I don't know if anyone's coming. I'm not coming. Whatever. I'll just kick this off. So you know, it's really interesting to invest in this period of time where things take a breather because I find, and it's quite perverse to say that, but I know that stocks go for periods where things go up and stocks go for periods where things go down. And that's just inevitable. But being with a prepared mind for those periods where things slow down, having that preparation pays off. And it's difficult because, everything is going red and it's like boring and it's challenging. But these are the moments that really a person has to be focused. When things are going to the moon, man, it doesn't matter. Like everything is going to the moon, no one needs to worry too much about stuff. But these are the moments that make a difference when at the end of this year we come to tally up how things performed. These are the moments to remain focused. And by remaining focused, I don't mean just kind of, being a hero and deploying capital, and that's not what I'm talking about. Is by a person being focused. Last week I talked about this kind of path where a person compounds the $10,000 to 150,000 over a 15-year period. And you know, it's difficult. 15 years is a long time of a person's life, it's a really long time, and it's difficult to remain focused for that period of time. But it does absolutely pay off by not losing someone's marbles and not becoming uninterested. And the best example that I can find about this was in October of 2022. The news everywhere was that, we are going to now see the final leg of this bear market. Things are just going to go absolutely bananas. And the news was scary and everything was really bad. But the share prices of stocks, now we can see in hindsight, but the share price were already kind of ticking up. But it would have been difficult to discern that pattern at the time. I was navigating through it, it was only 2 years ago, 18 months. And it was difficult to kind of see how things were going to unfold. The news was awful. It was like, and there was a lot of apathy. A lot of investors were kind of like, don't really want to bother with investing. And this period, in hindsight, would have made sense. But I'm not saying that a person can invest in hindsight, but I'm saying that a person can stay focused and not lose focus of what they're trying to accomplish. Because investing is something that anyone can really do, but to get that performance that we want, that everyone aspires to, is challenging because although it looks easy on the surface to kind of, let's say, buy a stock, sell a stock, it's really, really difficult to kind of see what's in the portfolio. I wanted to kind of just before I kind of go into my main topic, I was hoping that Daniel was going to show up. Because I discussed with him. I think I discussed with you, Mark, as well about this, but I definitely discussed it with Vasilis, and I definitely discussed it with Daniel. I wanted to talk just for a couple of minutes about AppLovin. So I had said, and I've been saying consistently that I would sell AppLovin before the end of before the earnings came out for Q2. I've been saying that, very consistently. I said it last week. And, I look through it and I'm like, okay, it's difficult here. I'm in a difficult situation because I want to get rid of this stock. But if the market is not going to pay me what I believe is a reasonable price for it, I'm not going to punish my portfolio and dump it to the side just because, the fuses run out. I kind of want to give it just a little bit more time because I know this is a really, really compelling business. And it's not a difficult thesis to understand. It's really not difficult. What you're looking at here is a business that kind of growing at about 25%. It's kind of. But what's interesting here is that one part of the business, the software business, is growing significantly faster than the rest of the business. So you got like these kind of two parts to it. Is like the advertising, they call it apps. So it's like AppLovin is like a mobile advertisement company. So you basically they enable the technology so that an advertiser, a company can put an advert on a game and kind of in a targeted way reach a user, and then they monetize that. So it's two parts of the business, and the advertising side of the business is not interesting. It's kind of slowing down, slash shrinking, makes a lot of free cash flow, but it's not interesting. Now, the other side of the business, the software business, is growing significantly faster. I believe that this will overtake the shrinking business. I think this is an estimate on my part, but it's going to be like this time next year, 80% of what AppLovin does is going to be the software side of the business. And I think that's really interesting because it has such a high margin. They don't even need that much salespeople to push the product. The margin is really, really high. It's kind of like close to 70% margin to EBITDA. It's really, really high. So I don't want to sell this business too soon. If the market is not going to give me my valuation for it, I'm not gonna dump it. So I'm gonna stick with it. So I kind of got derailed here. I don't want to talk for too long, so I'll just kind of jump what I want to talk about. When I think about investing, we go through these periods, these themes, where it's like the .com, or it's like the work from home, and this like AI stuff, and we go through these periods where it's like one decision. Oh, that's like a .com business, like it's going to go to the moon, or that's a crypto business, therefore anything that's related to it is going to go to the moon. And the market's like kind of looking for shortcuts, and for a period of time, these one decision investment strategies work really, really well, and you don't have to overthink it, and it works, and the stock goes up, and you're a hero, right? Everyone's singing and dancing, that's great. The problem is that you have to really think about it in this way.
Right.
Sorry, let me just 1 second. I'm getting slightly better at this. Okay, I think I'm muted the wrong person. I apologize for that. Oh, 1 second. Okay, I think we're cool. Afterwards, sorry, if you can unmute yourself if you need to talk at the end, like there's a couple of minutes at the end, we can chat. But for a long period of time in investing, the valuation of a stock doesn't matter. And this kind of ties a little bit to what I'm talking about AppLovin. For a while, like the market is either infused or disenchanted with a certain business, and it doesn't matter, like it's dead money or whatever, people not excited, or the people are really excited, and like you get detached from the valuation. But the valuation does matter. It really matters. And sometimes we get kind of allured by this siren of Wall Street. It doesn't matter, but it does matter. It really does matter. And more recently, I have seen a lot of these SaaS businesses, these software as a sales service businesses, just get absolutely crushed. And what I found is that what happens is that, it's partially management, partially investors. So investors crave the visibility. They want to know what the business is going to grow at in the next 12 months. They crave that, and they're willing to pay. a very high valuation for that quote unquote certainty. Management is only too keen to oblige. What kind of management wouldn't like their business to get a premium valuation? So these software as service businesses give the illusion that everything is under control, that the whole business cycle is under control. Once you got that customer, you have it on a subscription business, and it's predictable, and you can know how long the business is going to grow at for, and all this stuff. So it works both ways, really, because management are really happy to know what the revenues are going to be for the next, let's say, 3-6 months or whatever, and they can optimize their cost structure for that. So if you optimize how many people you hire, if you optimize how many people you need to get rid of, it's really great. So it works both ways, and it gives the illusion of that stability. Okay, but this is just an illusion, because businesses go through cycles, and at times management gets slightly too aggressive with their extrapolation, and when they pull back just by a few percentage points, the share just gets waxed. And you can see that with, let's say, MongoDB last week. Snowflake is happening that. UiPath, which is this kind of robotics, quote unquote, business, or pretend robotics, but anyway, that's a discussion for another period. So these businesses, and the same thing happened to me. So it's not that like I'm immune to this. I picked out Sentinel-1, they pulled their margin by 1%, and all of a sudden the share price gets hit as well. So the point I'm trying to make here is that it's important to think independently what the business's free cash flow is going to be next year, and don't get too caught up with what people are saying, including what management is saying. Try to be, a bit critical minded, slash, have some common sense, leave a bit of a margin of safety for yourself. And this works, really well. And you don't have to be a hero. Just kind of say to yourself, like, does this really make sense? Does it really make sense? Because sometimes it feels like it makes sense, and you're kind of paying a really high multiple for what is perceived to be a high quality company. And I find this is one of the most dangerous things to go down the rabbit hole of what is a high quality company, because all these businesses look like they're high quality until all of a sudden, like, the share price coming down, and it's like, oh my god. Like, the best example I find is this has been Snowflake. People were so enthusiastic about this. Or another one that, obviously this one's already kind of a bit old school now, but Unity Technology that competes with AppLovin, it was like, oh, like this, like, people just kind of go on and on and on. So just have a tiny bit of dose of, does this really make sense? Am I paying too much of a high valuation? Personally, so I'll just add a little kind of rule of thumb. This may be or may not be helpful to you. I think in these manners, and it may be helpful to you. So generally speaking, I find that if you get involved, let's say, a tech company, like predominantly a software company, if the growth rate starts to dip down below 20%, be careful, because the market will punish that by compressing the multiple. So be very mindful. Once it goes past that little hurdle of growing at 20% and it kind of slows down below that, be mindful. That's the first thing I'd say. The second thing is, I was going to talk about this, is that when I look through, there was this guy from Credit Suisse called Michael Mauboussin, and Michael Mauboussin put down a book called Base Rates about forecasting. And it shows that if you look at the S&P 500, only 1% of the companies in the S&P 500 can grow at 30% compounded annual growth rates for 5 years. 1% grows at 30% for 5 years. It's a really difficult call. And you have to think about that, okay? Now, I will add a little bit of a nugget to this story. If you look up Michael Mauboussin's paper called Base Rates in 2015, you can read there. On the first page, he says, and I kid you not, he says, if we extrapolated these growth rates very, very fast and look at something like Tesla, it would look like by 2026, the market cap of Tesla would be like 600 billion. And he was kind of saying that as a joke, that it would never be that, and that, it's unrealistic. And obviously, he put that there, and today we know we're not even in 2026, and like Tesla's already well and done, truly overshot that at some periods in time. So, it's important to have what's called like some common sense, but don't be too rigid as well. That's what I want to say. So I want to kind of play both sides of the equation here and say, think about these kind of things, okay? Like, particularly in software, these businesses are always like they're disruptors, and then all of a sudden they get disrupted. So just kind of have a bit of caution when it comes to paying for the valuations of certain companies. Another thing that I want to talk about is that when it comes, and this is really my final point, really, I wanted to talk about, when it comes to investing, perhaps the only thing that can lead a person to outperform in the market is having that humility to say, okay, I thought this, and it turns out that I was wrong. The quicker you can say I was wrong, it helps. It really helps, okay? That's the first thing. Just say it. You can just say it to yourself, it really helps. The second thing that I believe is if you look at your own portfolio and you say that there's a stock that you feel uneasy about it, say to yourself, if I didn't own this business today, would I be willing to buy it? And this kind of detaches a little bit from you. It's cool, like an endowment bias. An endowment bias is where if you own something, you have a higher personal attachment, you put a higher value on something than if you didn't own it. So if you just look at a business and say, okay, if I didn't own, let's say, pretend MongoDB, would I buy it? Yes or no? And if MongoDB is in your portfolio, would I buy it? Think about it in this manner. No, it doesn't matter the price that you pay. It matters what the new investor, when they look at your company, what will they think about it? So I've waffled on for a really long period of time here. If you have any questions, I'm very happy to discuss. Maybe you want to talk about uploving, what led me to change my mind there. If you want to talk about something else in the portfolio, a lot of people have written to me about LifeMD. If someone wants to ask me some questions about that, or some other things that you kind of in your back of your mind you're thinking about, this is like a time if you want to ask any questions.
I just wanted to know, I'm trying to freeze some money right now. So of all the stocks in your portfolio, which ones would you say I could more easily let go right now?
More easily let go.
And I have the opposite question, which would be, what are the top 3 stocks that you would like?
I'll answer Natalie's first. That's a really good question. Thank you for asking that.
If you had to.
Yeah. Okay. If I, this is just, I just want to be transparent with you. If I had to let go of something, I probably would get rid of AppLovin. I'd be happy to kind of, let that sail away. I'll try and think of 3 names if I can. Give me a second. I'll just look for 1 second, please. Oh, it's a tough one, man. Okay, if I had to, I'd hate to do this, but if I had to, I'd get rid of Samsara. So get rid of Upload and get rid of Samsara. I'd find it really difficult to do this. Probably get rid of Robinhood. It's really difficult, but I'll do that. Yeah, those 3. I find that, you know, the thing with Robinhood is that it's a business I really, really like, but you know, the valuation's kind of getting close. It's around 22. I've been pushing this for, you know, since it's been around $10, $12. I don't have that excitement, you know, that I did before. I know it can do well, and it's a difficult, because I've been really careful to not overstay my welcome on a lot of stuff. I've been really careful in preparation for this period. we knew for certainty that at some moments the market will slow down. So I've been really careful to kind of, you know, what I've been very, very mindful to think about the valuation and stuff. So it's a really difficult question to answer. I've tried to be very open and transparent with you, and hopefully you find that useful.
Okay, great. Normally you would tell us right away if the market is slowing down, and okay.
Yeah, I mean, so let me just caveat 1 minute, please. Nobody knows whether the market's going down. Nobody knows this. I would try to say, okay, listen, I'm wrong here, and I would be very transparent and say, okay, listen, and like I did many times. You and I have been on the call. I've said about GitLab many times. I've spoken about that. I've spoken about, obviously not in the portfolio anymore, but I've talked about Palo Alto Networks many times. When I feel like, okay, you know, I feel like there's some doubt there, I'm very transparent. I've always said, you know, this is how I feel about certain things. And I also said that, yeah, this brings me to another one. If I had to get rid of something, probably will also consider getting rid of Palantir, because I want that stock to get to 30, but it doesn't matter what I want. It matters what the market will give. Last time I checked, it's around $22. Generally speaking, I like to believe that my stocks have at least 50% upside for me to stay with them. I need to believe that, because you know the market will turn on you in a moment. So I need to believe. I'll give you another example. So I'm waffling on here a minute. So when I recommended PDD, the Chinese company, I knew that, you know, selling to an American audience, that PDD is a Chinese company and it's going to be a difficult sell. But I needed to believe with all my might that I could see a 50% upside. I needed to believe that. So that, and when I recommended, they recommended, it just tanked. It tanked immediately. But I was sure, I was like, no, it doesn't matter what anyone else tell me. I've got this one. And like now, you know, I can speak in hindsight, it's recovered to where it was. It's some break even. I lost time, but the valuation is the same. But I needed to believe that I could see that 30% upside. So I am very constantly thinking about, is there anything that I can prune here? So that's why I'm kind of like really kind of being hesitant with this difficult question, but I'm trying to be very, you know, very transparent with you and say, like, this is what I think.
Great. Thank you so much.
Thank you. Hi, Rob. Can you hear me? Okay. You're nodding your head. You're muted, I think. Doesn't matter.
I can hear you. I'm muted because my dogs are barking in the background.
It's cool. It's a real pleasure to finally meet you. I know we've kind of exchanged messages a few times. Thank you for coming. Really appreciate your time. So every let me think this through. Every Monday, I didn't do it on this Monday, but I did it on Tuesday because I was busy yesterday. I put on the chat, I put 3 names. Every Monday, I said, okay, these are the 3 names that a person can consider if you got some extra capital. So I don't believe that you're on the full tier. So I'll just tell you up what I put down for the 3 names that I put down for this Monday. Just bear me a second. I'll just look here. So I put down Sezzle, Auster, and Hims. I put these 3 names down. So Sezzle is kind of like a Canadian version of a buy now, pay later, kind of like.
Oh, I'm familiar with Sezzle, and I purchased it once I rejoined. So thank you.
Cool.
Yeah.
So that stock is really volatile. You know, I say this to everyone on every occasion. Small cap investing is really difficult. It's really, really difficult. The moment the market hits a pocket of air, like those small caps just like melt away. But the underlying businesses often cases are quite strong and quite resilient. But sometimes we just see the share price and we kind of think that someone knows something, and it's not necessarily true. So that's the first thing I'm saying. I like Sezzle very much. Really, like, it's back to where I recommended it, which I think it's about $75 or something now. It was only like, it was at 92 3 days ago. So it's like, you gives you an impression of how volatile this business is. But on a GAAP basis, it's like dirty cheap, like 9 times earnings, that ballpark. Maybe, like, I don't know what the growth rate will be, but this is the thing. It's kind of growing around 20%. And if it's growing around 20% and it's already GAAP profitable, I think straight on that face, okay, that looks interesting. And if it's making like close to 9 times, it's priced 9 times earnings, I'm like, whoa, I feel like this is okay. You know, I'm quite proud of this one. The only reason why I don't push it too hard is because it's really volatile. So the market cap, I don't remember the exact number, but it's approximately 300 million or something like that. It might be a little different from that, but it's really volatile. So that's why I'm kind of cautious about that. So with HIMS, I believe, so I've spoken about HIMS quite a few times, but I'll just briefly say, I don't see how the market is willing to give this whole different segment of their business, this GLP-1, enough credence. Like no one's really thinking about this. I feel like the share price did go up and it kind of back down, but it hasn't gained enough momentum relative to the opportunity that they're targeting. So they have a business that's fully established and highly profitable already and growing fast. Okay, they have this business, and then they kind of go into a new business stream, and the market's like, forget that. It's as if, like, say, it's obviously we don't know how successful it's going to be, and there's a lot of competition. But hypothetically, just as an example, and I hate to use examples because, you know, no two businesses are the same, but just humor me. When I look at something like Amazon, Amazon was a retailer and he had this established retail business, and they try and go into the cloud. Now, obviously, the cloud has a lot of competition. There's so many different cloud providers. There's no, like, you know, Microsoft does something similar, Google does something similar, IBM does something similar. No, but it's like the market saying, forget that side of the business. We're just going to not give it enough credit. I feel like, you know, that's a bit of an unfair punishment. And the final stock that I kind of recommend was Ulster. And this is simply because I think that the market is not understanding that they will need to raise less capital than many people expect. So when I first looked at this business, my time is pressing, I think I can't remember now. I don't want to lie. Might have been November or so. I felt we're going to have to raise kind of about 100 million of equity. And then I looked at it, I think it was like March or so, and I felt, okay, maybe they can get away with just 40 million. And then the results came out and they only raised about 4 million. And I was like, okay. And obviously, the higher the share price goes, the less you have to dilute the shareholder. So I'm like, this makes sense to me. They're growing really, really fast. And you know, all these robots in the future, they're going to need some types of sensors to detect like movement and stuff. So I'm like, okay, if you're going really, really fast, there's only the question mark of when you're going to reach profitability. And I like these type of setups because this is one area of the market that I think that the market is not very good at kind of trying to price in. The market's really good at pricing in businesses that are stable and growing with a certain amount of profitability each quarter and growing. The market's really good at that. But when the market goes through, when a business goes through a period where it's unprofitable, breaks even, and then profitable, I feel like the market is not that good at pricing that in. So this also is another business, and I've written that up. That's another business that I really like.
Thank you.
Would anyone else like to ask any other questions? Nope. Okay. Thank you very much, everyone. Really appreciate you guys coming. Thank you very much. Hope when we come next week, the market will be stronger. We'll see. Okay. Thank you so much. See you next time. Bye-bye.
Thank you.
Thank you so much. Bye.